Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, Wall Street is rolling the dice, naming the stocks it says will rocket higher, along with the ones doomed to fail. I'll take you through the 10 stocks with the highest potential return according to analyst estimates, one with a 60% upside that I've been buying since February. Stick around and I'll show you why shares of Super Microcomputer jumped 14% last week, give you a giant warning on Walmart, and update our stock market outlook. But first, I'm excited to announce your chance to get a share of the monthly revenue generated from this channel. Starting last week through the Gigastar platform, I'm offering 15% of the channel revenue to investors. This is the third and last investment round we'll do before the secondary market opens later this year. Almost 700 investors joined us over the last two rounds to get a piece of the channel revenue, and have collected over $48,000 in distributions over the last 2 years. Last year, we raised $123,000, and those investors have made over $20,500 in distributions, almost a 17% cash return. In fact, the channel revenue has grown to over $120,000 over the last year, nearly double the revenue over the year before, and I've got some great ideas how we can take it higher. More than that though, investors receive special access to perks, access to the private Discord channel, investor-only live streams, and all new video courses absolutely free. The offer is only open for another 2 weeks, and those diamond tier tokens are already sold out, but you can get those same perks by investing in multiple platinum or gold tier tokens. I'll leave a link to the Gigastar platform in the description. Click through and you'll be able to see all the details, ask questions, as well as see the official documents I've filed with the Securities and Exchange Commission, the SEC, for this investment offer. Back to our main topic though, and FactSet Research is out with its ranking of top 10 stocks by average analyst price target. The firm surveys analysts covering the S&P 500 stocks, compiles the data, and then produces a great weekly report that is full of useful information. Every quarter, it shows the S&P 500 stocks with the largest difference between analyst average price targets and the current price, both to the upside and the downside. I always like using these tables as a heads up on the stocks to watch, but of course only as a starting point for more research. Everyone loves to glamorize Wall Street analysts, but when I was an analyst, I learned many of these guys were only there because of some Ivy League pedigree or connections. It definitely wasn't their work, because more than a few struck me as the kid you had to keep reminding not to eat the paint chips. But then looking at those consensus calls and the targets on the stocks can still be useful, starting with that list of stocks the broader analyst community thinks should be higher and using that to start your own research. From there, I'll dig into the bear and bull case for that stock, why it is in a value territory, and then pick out the best stocks to buy. I'm going to highlight the top 5 stocks on the upside of the average analyst price targets, starting with PG&E Corporation, ticker PCG. It's been 7 years since that power equipment belonging to the California utility provider sparked that massive wildfires that tore through the state and pushed the company into bankruptcy. It came out of bankruptcy in 2020, but the shares haven't fully been able to kick that stigma. The company is heavily investing in its infrastructure and is helping to fund an emergency wildfire fund. And those increased capital expenditures are going to weigh on the earnings, but the upside here is more about removing that stigma and bringing investors back than it is about earnings. If the company can prove that it is in a long-term recovery, the shares could do well on a rebound to those normal valuation multiples. Right now, PG&E trades for a price of 1.4 times the company's sales and 14.5 times its reported earnings per share. And that's while peers like Dominion Energy, ticker D, and Duke Energy, ticker DUK, both trade for more than 3 times their sales and 20 times reported earnings. So if investors do become confident that PG&E can put those existential risks behind it, then a re-rating back to the industry average multiples would take the stock up 38% on its PE valuation and 114% on that price to sales multiple. Analysts are optimistic here that it gets close with a $21 per share average price target, up 45% from here. Next up, Chipotle Mexican Grill, ticker CMG, has seen its shares plunge 33% this year on a sell-off across the fast casual food complex as consumers pull back on those outings, along with a still weak lunch market. The company cut its full-year sales forecast in July, citing an uncertain economic environment, and has now seen growing sales by just 7% this year, half the growth it reported last year. And trading at a price of 4.6 times sales, the stock is at a 40% discount to its recent price-to-sales multiple, and analysts see a 47% upside to the $58 average price target. But this is one where investors are going to need to have that patience to wait out the tough consumer environment before a turnaround. Dexcom Inc., ticker DXCM, fell last year when investors were worried that those GLP-1 weight loss drugs would sap demand for the company's diabetes monitoring and management solutions. While sales growth has kept up and is expected at a 15% pace this year, investors just haven't returned to the stock. While the stock could claw back some lost ground to its average analyst price target of $102 a share, a 49% upside potential, the coming approval of weight loss pills are likely to hit that sentiment for the company again, so this is one where I would wait for another dip to start buying in. Shares of Align Technology, ticker ALGN, got crushed in August on an earnings report that missed expectations and provided a weak full-year guidance due to some increased competition from copycat products. Now on growth of just 0.5% this year and 3.5% next, there are a few catalysts to the upside, and this is probably my least favorite of the top 5 analyst recommendations. Analysts do see a better than 50% upside to the consensus price target. But understand, part of these highest potential stock picks by the analysts are just a function of those big drops in the stock price, creating a gap with those target prices, and some analysts are just too afraid to downgrade the stock based on that new information. So you definitely want to do your own research and understand that bear case. And the trade desk, ticker TTD, has been one of my favorites and could have a catalyst coming when it reports earnings early November. I started buying just after the stock crashed on its fourth quarter earnings reported in February, when a disappointing outlook added to those fears of competition from Amazon that would eat into the company's dominance in connected TV advertising. And that competition never really materialized, and the stock shot up when TTD reported its strong growth in its May report. Those fears are now back again though, first with another disappointing outlook during its second quarter report, and then with an ad partnership between Netflix and Amazon, sending the shares down 45% from early August. But as we saw in May, even if those fears of competition do slow the company's long-term growth, I think we see management come out and report another solid quarter for its sales and earnings. Analysts surveyed by FactSet have a $75 average price target, a 60% upside from the recent price, and we could continue heading that way as we get closer to that November's earnings report. Rounding out the top 10 stocks are some good stocks for further research here. We'll dive further into EPAM Systems, ticker EPAM, this Wednesday as one of the best deals in AI stocks, the 5th lowest price valuation when adjusting for growth. Analysts have a $215 price target on the stock, a 43% upside. Now, I've highlighted Fiserv, ticker FI, on the channel before as one of the undiscovered plays on that coming stablecoin era. The shares have sold off recently, but could have a 40% upside to this analyst targets. But then on the list of stocks most overbought based on those analyst targets, we see many of this year's highest flyers, and some of them have just outrun those targets. Shares of Intel, ticker INTC, have doubled from this year's lows on an investment from the US government and Nvidia. Now, I am still skeptical that the company can be successful at both design and manufacturing semiconductors, competing with Nvidia and AMD in one area and then against TSMC in the other. Analysts have an average target of just $23 for Intel, 32% below the current price. Seagate Technology, ticker STX, and Western Digital, WDC, are each up almost 200% this year on a resurgence in storage demand on that AI data center buildout. Both are very expensive against historical valuation multiples and trading from 12 to 18% above analyst targets. Now on to the stocks I'm watching this week. Walmart, ticker WMT, is up 12% for the year, bucking the weakness we've seen in other retailers, but could have a nasty surprise coming for investors when it reports its earnings November 20th. An investigation by CNBC found widespread fake accounts by third-party vendors on its Walmart.com, finding 43 vendors impersonating others on the site. A former Walmart team member on that vetting team attributed this to pressure by the company to approve everyone for that sake of growth. Expectations for revenue are modest at just 4.3% growth and flat earnings for this current quarter, but what worries me is the outlook for coming quarters. If Walmart is forced under public pressure to scrutinize and take a closer look at vetting those third-party online vendors, that could limit the upside growth compared to its expectations. Analysts expect the company to boost its earnings by more than 12% next year against just 5% revenue growth, both a stretch already with a weakening consumer and tariff-related costs that just are not letting up. The bigger problem is that almost all that growth is expected to come from that e-commerce segment, which posted 37% revenue growth this year and is around 10% of total sales. So if management is honest here, it's going to have to warn that stricter vetting process may slow down this pace of growth, bringing the revenue outlook down and costs up. If management doesn't acknowledge the issue, it might not become an issue during this November report, but could blow up even worse in the near future. Natural gas stocks have more room to run on the power grab from AI data centers, with energy demand expected to double by 2028, according to Berkeley National Laboratory. Between the trade deal with the EU, that saw a commitment to buy $750 billion in energy exports from the US over the 3-year period, and surge in demand from those data centers, natural gas and related stocks could have years more upside in this bull market. Shares of utility provider AES Corporation, ticker AES, popped 15% last week on reports that BlackRock-owned Global Infrastructure Partners was in talks to acquire the company for $38 billion. For the stocks to watch, midstream pipeline operator Energy Transfer, ticker ET, signed an agreement to provide 1.2 gigawatts of off-grid power for a data center operated by Cloudburst in February. Also here, Expand Energy, ticker EXE, last year's combination of Southwestern and Chesapeake Energy that created the country's largest natural gas producer, already up 24% over the past year. Another pipeline operator, Williams Companies, ticker WMB, is also aggressively targeting that off-grid data center growth and is up more than 30% over the year. Supermicrocomputer, ticker SMCI, popped 14% last week as the shorts continue to get squeezed. OpenAI's $500 billion valuation to become the world's largest private company, and continued spending on data center infrastructure, of which SMCI servers are a major part, pushed the shares higher, along with the launch of the Yield Boost 2x Long SMYY ETF by Granite Shares to track along with that stock. Shares of the AI-focused server maker are up 72% this year on 45% sales growth, and still one of the best deals in the theme, trading at just 1.5 times on a price-to-sales valuation. Giving you the bigger picture here with the Sector Spiders Sector Tracker, 7 of the 11 stock sectors closed higher last week, with drug stocks and healthcare rebounding on that relief that tariffs can be avoided. And stocks in the utilities and technology sector continue to be driven by that AI infrastructure theme. Energy stocks were the obvious losers here on a crushing 7% drop in the price of oil, with Saudi Arabia saying it would increase production. We are at the low end of the multi-year range in that oil price, and hesitation from U.S. oil producers, especially shale explorers that need around $62 per barrel for break-even, should help support oil and oil stocks from here. And the bigger story, though, was the continued weakness in consumer stocks and how it plays into that jobless expansion narrative. Stocks in the consumer discretionary sector fell last week, kind of an oddity as the sector generally does well when the market is up, and stocks of consumer staples barely closed higher. Weak jobs data last week from the private survey rather than from the government continued to show that weakening in the labor market. Now that combined with companies gradually passing those tariff costs on to consumers means consumer spending is not in a healthy place. Unfortunately for the market, corporate investment is still very high and profitability is holding up as that wage pressure falls. This is really driving real weakness in those consumer stocks that's likely to get worse before it gets better, but not affecting the overall market or keeping it from reaching those new highs. And updating our stock market outlook, the federal government shut down on Wednesday last week. You wouldn't have guessed it from the stock market though. And in fact, shutdowns generally don't affect the market that much in terms of prices. Federal government workers are furloughed and receive no pay, but then receive all their back pay after that shutdown. And that means while the shutdown can hit the current quarter GDP, the economy, by as much as 0.5%, as was in the case of 2013, much of that is made up by slightly higher growth in the next quarter. But it does mean that we won't see those government-reported economic data to guide investors. Now that isn't likely to keep the Fed from lowering interest rates further when it meets on October 29th, with the market pricing in 96% odds of a quarter-point cut. In fact, it actually gives the Fed another reason to cut rates, supporting the economy that's going to have to contend with that short-term pain of the shutdown. And we do see 10 Fed bank presidents and governors of the board speak through the week, a busy schedule of Fed speak, and I think we could hear comments supportive of those more rate cuts to come. Third quarter earnings start coming out next week, and even Wall Street is getting optimistic, with analysts actually increasing their forecast for the earnings through the quarter. Now, understand, generally analysts revise their earnings estimates lower through the quarter as management at companies tries to kind of fine-tune those expectations in order to beat them when those earnings are reported. Of the last 19 quarters, analysts have lowered their forecast for earnings per share at S&P 500 companies during the quarter in all but 5 of those quarters. And that makes the 0.1 increase in EPS forecasts over the last 3 months an outlier and implies better than expected and healthy corporate earnings growth. Even more surprising, though, was that the largest increase in earnings forecast was seen in the energy sector, one of the weakest sectors this year. Analysts upgraded their forecast for earnings growth in this sector by more than 4% over the last 3 months. Now, it hasn't necessarily helped the group, though, with stocks in the sector only up 2% against a market almost 7% higher for the 3 months. That, combined with support for the price of oil around $60 a barrel, leads me to believe that these oil stocks are in very attractive positions going into earnings. Click through below and get your share of the revenue from this channel. Look for the link to Gigastar Markets and invest in the Let's Talk Money channel to get monthly payouts and join 700 investors in the channel. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.